Hi, I'm Peter Rose, founder of Longwood Currency Trading. Are you making these 3 mistakes in your Forex trading? I'll tell you one mistake I almost made. Was doing this video outside today. I'm looking out the window here and it is pouring like crazy. And I go and look at the weather report and thunderstorms and all that other stuff. It's just pushing mid-August of 2023, so you would think that we're not having as much rain, but we are, and so it's a mistake to plan. I'm going to have to do a video if it's going to rain, which I didn't know until I was already out there with my camera and it was raining at me. 3 mistakes. Are you making them? I made them. It cost me tens and tens of thousands of dollars, not only when I made them, but when I make them, because I'm human and I'm still culpable to these things. And even as experienced as I am, I've been studying these markets since 2007, been involved in the financial markets since the mid-1970s. I had a 40-year career in real estate. I get trading and money management and all the rest of that stuff. But you still make mistakes. And that's why when I see folks that are supposedly educating you, they talk about silly metrics like risk-reward trading or win rate. Those really lead you down a dark path. It's unfortunate that some of the folks that are talking about this stuff are very experienced in what they're doing and they're very successful. But that doesn't mitigate the fact that the information that they're conveying as to how they got successful and how they remain successful isn't quite right. Your success in trading is based on one thing: your skill at trading, not all this other stuff. And once you start worrying about responding to a risk-reward ratio or a fib level or a win rate, you're changing the way that you think about the problem that you're trying to solve. The 3 mistakes I'm going to talk about are trading mistakes. And if you're cluttering your mind with the other stuff that appears to be mistakes, you're hiding the true issue of it, of the trading, of the problems that you're going to face in trading. So the 3 mistakes, and I'm just going to rattle them off up front. So if you're not interested in hearing about these mistakes or you don't think you're prone to them, you can just shut the video off and you've only wasted a minute of your time. But I'm going to be talking here for probably about 20 minutes on this stuff. So the 3 mistakes that you want to be aware of, that you're culpable of, no matter how skilled you are or whatever, is number 1, holding your losses too long. Number 2, doing what I call anticipatory trades. Oh, it looks like a trade's going to happen, I'll take it now. Boom, that kind of thing. Number 3, trying to trade for too many pips during any one particular position or holding session. Okay, so let's get back and to the front of that line and talk about number 1, holding your losses too long. I mean, it sounds stupidly simple, a rule. You go, oh yeah, I don't want to hold on to a loss too long. The problem is that you evaluate the position during your entry analysis and you go, oh, I think there's going to be this trade and it's going to go from X to Y, okay? But it doesn't. It turns around and goes in the opposite direction. And you're sitting there with the reason that you risk $10,000 or $400,000 of your money to go into that trade was because you believed it, you did your analysis, and you acted on that. So even though you may set that 10 pip stop or that 20 pip stop or whatever it is, that's your normal thinking. Well, if it goes to here, I'll get out. But you see, that's a conflict. You do all this research up front, this analysis, and you determine that that's a good trade. And so when you get close to that stop, oh, well, it's only reacting to the 21 period moving average, and then it'll flip around and go, oh, there's a resistance zone there because there's so many orders, and it'll flip around and it'll go in my direction. Or whatever the hell it is, and you pull the stop. Or you have a mental stop because you're scalping or you're doing real short-term trading, and you go, well, another 5 pips won't hurt. 5 pips on a 10 lot is $500. I just got hit with this morning. I did my analysis. I did everything that was viable, and it was an early morning trade. I got up, I looked at the thing, I put my order in. It was a heavy order and a short distance to my profit target, because I thought, well, what's going to happen here as we get a little further along in things is the price is going to react here and it's going to do X, Y, Z. Well, it didn't do that because some news came out and the price went, well, the full transition of the price was something like 60 pips. Just like that. In 1 minute. And because my trading distance was short and I was there ready to react, 1 minute, and you see this spike go up, oh, it's going to stop at the 8 period moving average. Nope, it's going to stop at the 21. Nope, it's going to stop at the 55. No, it went 40 pips beyond the 55. Oh, okay, let's switch the time frames and go up to the hour. No, that isn't going to work. There's nothing there to stop it. Let's go to the 4. Oh, wait, this is what's happening. It's doing, and so I'm sitting there and, okay, I got a $5,000 loss, and I'm saying, well, I'm going to stay with this because this looks like an anomaly. It looks like a large institutional trader hunting orders and then moving price against the market in expectation, and is scooping orders. Now, even though the price moved in what would be the direction that the news would indicate it should go in, my analysis says that the price shouldn't go in that direction, that the price should do what it's been doing, and it should continue that. And so this is an institutional trader that's loading up on their inventory, and then when it gets as far up as it's going to go, there's going to be a dramatic reversal, or they're going to unwind that position over a longer period of time. Price will creep back down. Well, price will come back down 50% of that anyway, just because this is a zero-sum game, and I've discussed this before. I'm not going to get into detail here about why it would do 50% anyway. But then it should proceed on, because this trader doesn't want to just take advantage of a normal retracement that the retail traders are going to create. He's waiting for the big move, and then he's just going to flush everything out. Is that going to work out for me? I don't know. The problem is I shouldn't be in this position. Whenever you set go into a position, you should always have that hard stop there and then go get a cup of coffee. And if it hits, it hits. And if it goes in the direction you're going to go in, when you come back in, you go, oh, I'm in profit. I'll move my stop down to, I make 3 pips and, I'll be out. And then it reverses and comes back 8 pips and takes you out at the 3 pip thing, and you end up making 3 pips. Well, that's okay. That's a lot better than being 5 big down, okay? So let's just make sure that you don't have that decision process, that you don't have the conflict within yourself about, oh, I made this choice, and oh, it's going against me, but I'm going to hold it because, for whatever reason. You don't want to make those choices in real time. What you want to do in your entry analysis is make the choice that you think is probabilistically the greatest situation that's going to happen, and then if it goes in your favor, that's great. If it doesn't go in your favor, get out, step back from it, and reevaluate things. So that's number one. Number two, anticipatory trades. Many times when we do our entry analysis, if you understand the process of entry analysis, and it took me a long time to learn that, because I didn't have anybody that understood entry analysis that was able to talk to me in anything other than fib levels and all this other shit. Look, I got a degree in physics and almost a minor in math. You know? Oh God, it's just silly. In any event, anticipatory trades is a trading mistake, not a technical or mechanical or news-based or anything else. You're looking at the price action. You're not in a position right now, but you're looking at that price action, and it's indicating the price is going to move to this point, and then it's going to just go because of XYZ reasons. And that's great. If you think it's going to get to a certain point and then go in that direction, that could be a deadly error for you in currency trading, because things don't just move gradually and then go like that, unless there's a big institutional player involved and you don't know what they're going to do when it comes time to reverse that and take the liquidity out of the market. So an anticipatory trade would mean, well, I think it's going to get there, and so instead of waiting until it gets, let's say, higher above, you're going to go long. I think it's going to get to here, and eventually it'll get to here, up to there. So why not get in early? And that early is 8 pips or 10 pips. Well, that's $100 a full lot. That 10 pips is an extra $100. So you don't want to give up that $100 between where you're thinking that price will obviously get to up here, 10, 20 pips above that. If you really think that it's going to go beyond where this position is and go 10 pips, then if you got in here, your one lot would go 20 pips and you'd have $200. You'd be anticipating that price is going to get to here, at which point you'd add another one lot so that it would go to there. You got $300 now on the position that you took here, and you got $100 on the position that you put in at the place where it should be put in, and it's going to go forward from there. So look at the money you're going to make. That's the anticipatory trade. It's a greed that's too early. What you need to instead do is say, oh, this is where I think this is going to go. But to protect myself, I'm going to wait until it gets here. And when it gets here, I'm going to, instead of going in with one lot, I'll go in with 3 and just see what happens. And then if it moves and continues to go up, or maybe one lot, I'll add a couple of lots. And if it goes up a little bit more, I'll add a couple of more. That's the greed. That's where you need to be greedy, not fearful. You need to be fearful about where you're setting that initial entry point. And even though it would go up to the point way up above where you would anticipate the trade and getting in early, that's no indication that you should load up your position at that point. You use the same entry guideline rules as to how to size your account at entry, as opposed to where you're going to build the position to, and then if you've got the dry powder, you've got the money to trade more lots, how you're going to stage future lots in. That's risk management. I didn't have that particular process for the trade that I'm in today. I went in with 8 lots at the start, and I was going to come out at 8 lots. It was going to be really fast and really clean. I was just trying to make $500 with a quick drop of 5 pips. It was clean. If the news wouldn't have come out, then what I anticipated happening would probably have happened. But I don't follow the news. I don't care. I should have had a stop in place. I put the trade on. I turned away. I'm getting ready to get my coffee. Came out, get my coffee. The trade still hadn't gone off and hit. It's just fluttering around. I'm answering a couple of emails. It goes, boom! I heard the phone go off. I look at the phone. Okay, go in to the trading platform. I'm looking at the price, and all I'm looking at is a friggin'. It was a short position. I'm looking at a 30 pip pin bar in the wrong direction. It went down and grabbed my 8 lots and went 30 pips above that. So you figure it out. 80 bucks a pip times 30, $2,400, like that, in about 40 seconds. So I should have set that stop. I didn't, because I was thinking more in terms of a scalp. And when you're scalping, you don't have time to set these limit orders. The gauge that I misread was that anticipatory thing where I said, I'm so certain that this is going to go down 5 pips. Why would I just put a 1 lot in there when I'm going to trade 8? Why would I put 1 lot in there and get my 5 pips and I make 50 bucks when I could make 500? That's equally an anticipatory trade. It was a mistake I made today, and that may cost me $5,000, $6,000, $7,000 before I finally go, this isn't fucking working. Maybe I'll report back on another video as to what happens, because I'm very upfront in my videos as to my failures as well as to my successes. I mean, that's the only fair way to balance for someone to view what I'm doing as to whether they could duplicate that. You might not be able to duplicate right away the amount of money that I'm making, but from a percentage point of the bank that you do have and the number of pips that you gain, if you understand how to trade, you should be able to make those same percentage gains. And if you follow those rules, which today I didn't, you'll be fine. In the last 7 days of trading, 6 days of trading, I made a little over $5,000. Just picking away at it and following my rules. Today, what? I think I'm a hero, and I go in and now I'm $5,000 down. So I've lost all that money unless it comes back. If it doesn't come back, I start the month over again. If it does come back, I'm going to be very lucky, and I'll probably just get out at a break, or maybe take a 2 or 3 pip profit and just call it a day, because it was a bad decision not to put that stop there and take, I don't know, $600, $640 stop because of that volatility that was there. Why not take the short stop and just get out? Anticipatory trades. Don't do them. Number 3, trying for too many pips at your profit target. You know, I've said many times that I look at a trade. I'm a day trader. I'm on a 5-minute chart that has characteristically an ATR of about 5 pips. Today we're going to get an ATR of 20 pips on it. You know, but characteristically over the long term, I'm working with about a 5-period ATR and 5-minute chart on a major currency pair, not an exotic or whatever. And I'm not leveraged at 200 to 1. I'm getting really strict risk management. I trade 10 to 1, and that's it. I may go 12 to 1, but not anything more than that. So I've got plenty of runway, but that's just risk management. Okay, trying for too many pips. That has nothing to do with trying for too many pips. In so many of my videos, I've talked about the value of 1 pip. I've talked about the value of 3 pips. 3 pips on a mini lot is $3. $3 is 3/10 of the $1,000 that you want to fund your mini lot account with. Now, in the United States, with a 5% margin requirement, you may need $650 of margin on that mini lot just to put the order in. And so what are you going to trade? Just with a $700 bank? You should have a $1,000 bank to trade that one mini, because that gives you 300 at least, 350, maybe even $400 of runway, or 400, 400 bucks. Well, on a mini lot, 400 bucks is 400 pips. Don't you think you'd figure things out correctly before you got margined out or margin called out, and you lost 400 pips? So if you're making 3 pips 1,000, $3, that's 3/10. So if you're trading 10 full lots on a $100,000 account, 3/10 of that is $300. A lot of people don't make $150 a day, much less $300. $300 a day, 5 days a week, is $72,000 a year on 3 pips on a 10 lot. It's $720 a year on a 1 full lot. When you look at what you're trying to accomplish in your trading, all of the info that's out there is, we got so many pips, and we got this many pips, and we got that pips, and you ought to come and study with us because we're going to show you how to get more pips. No, what they're going to show you how to do is lose your money. Because the more you strive to get more pips, or the more you compound that account underneath, you're just setting yourself up for a major failure. Part of your trading plan has to say, I've got a trading, once you figure out what you're doing, and if you don't know how to figure this stuff out ahead of time as you're starting, so you know what you really should be focusing on instead of the other things that people are telling you to focus on. But if you've got a good win-to-loss ratio and are working on improving that average win value that you're looking to compare in that equation, the win-to-loss ratio equation, you need to determine what time frame you're going to trade on and what the ATR of that time frame is over the long term, and how far price moves in the period of time that you want to trade, if you're a day trader. If you're trading up on the higher time frames, like if you're using the daily chart and picking your entry analysis, doing your research at the close of the daily candle, and then putting your orders in for the next day in relationship to that, you've got an ATR on the majors that runs anywhere from 80 to 120 pips. And so where are you going to put your stop when you put that order in? Because if you're trading on the daily chart, you're not trading for 10 pips. You're trading to get 200, 300, 400 pips. Look, if you're down on a 5-minute chart, how far do you want that price to go? You're going to try to get 10 pips or 20 pips or something like that? Well, what is that? That's 20 pips. So are you up on the daily chart trying to get 20 pips on your trade by tomorrow? Where are you going to put your stop? If you're trading up on the daily chart, you got to put it at an ATR away. So you got to put your ATR 80 to 100 pips away, 50 pips away, 40 pips away. And if you don't have a good win-to-loss ratio, you're going to lose 40 pips more times than you're going to make the 20. Far more times. If you're a 70-30 trader, you might be able to make up that difference winning 20 when you win and losing 40 when you lose. But are you going to set a 40 pip loss? I took a course from a guy, he's been on TV. He's good. And he was teaching a methodology, a system, where your profit targets were 150 to 300 pips away, and your stops were 50 to 100 pips away. If you're not an experienced trader, you're not going to make that work. The mathematics will tell you that that isn't going to work. So the advice that I can provide for you is that based on the analysis that you do for the time frame, the ATR, whether you're going to be a day trader or swings or whatever the heck it is you're going to do, you have to take all those things into consideration and say, for the period of time that I'm going to be in that trade, how many pips is reasonable for me to get in that time frame? If you're a day trader, you'd say, well, I got 24 hours. No, you don't. You're not going to sit in front of that screen for 24 hours. You got to go to work. You got 2 hours in the morning maybe, or you're going to set your stuff and trade at 5 o'clock at night. Maybe you find some pairs that have enough volatility at 5 o'clock or 7 o'clock at night when you get out. Maybe you trade the Asian session at 8 o'clock at night for a couple hours. I mean, that's what I do. I'm on the East Coast of the United States. I trade for a couple hours in the morning. I want to be done. If I can't make any money or I got stuff going, I close it all down because I don't want to trade all day. And the reason that I do that is because 95%, 99% of the people that are listening to me are working. They don't have the 8 hours to sit there and let their trades run. And they're not skilled enough to set it and forget it with trailing stops and projected profit targets and all that other stuff. You see some of these guys, they're trading all day long and they're making consistent money. If you could trade all day long, you could, and you're very disciplined and you take those little tiny losses and you're in and out, you'll be fine. But you have to be skilled at the trading. So if you want to trade and you're not having the results that you feel that you need to have, it's probably because you're looking at somebody that's trading all day or that's trading up on the higher time frames and you're trying to duplicate those processes. You're not going to be successful doing that. That's why I trade 2 hours a day. That's what I want to do. Because that's what most of the folks that are watching my videos, that's what they have to do. They've only got an hour or 2 hours that they have that they can trade. And they don't want to go off to work with an ongoing position. Because 99% of people, when they go to work, are not going to be able to check their charts to make decisions. And you're damn sure not going to be able to manage a position on your cell phone. Trading on a cell phone is asinine. Yeah, you can do it for a while, but eventually it's going to catch up with you. If you find any successful trader that trades on their cell phone, you won't be able to find him. He's not going to be able to do it. He may be trading on that cell phone, but he's not doing the analysis on that cell phone. And he may be in a position where he's doing a swing, trading swings or long-term stuff. He does a set and forget, and then he's just using the cell phone to check his positions. I do that at nighttime while my wife and I are sitting watching episodes of Suits on Netflix. I got my cell phone, I can get the chart open, I can look at it, I can see what price is doing. If price does something that's pretty neat around that Asian session or 8 or 9 o'clock at night, I look at the thing and I go, oh, look, I ought to go into my desktop and take a look and see if there's some trading opportunity here. Maybe I could make a couple $100. And pause the movie or whatever for a couple of minutes and go and make a couple $100. That's fine. But it's not trying for too many pips, because you only want to try for the number of pips that you're going to be able to get for the time that you're going to sit there. If you do it any other way, you're going to end up losing money. I guarantee it. Look, I started trading live accounts in 2012. I've been studying the currency market since 2007, but I did them as an academic exercise. And I'm a computer programmer. I spent 33 years as a senior software engineer doing applications development, business applications, code development. So I'd write simulations and do all that stuff. In 2012, I thought, well, maybe I ought to try this trading thing. I've been reading all the books and studying on videos and all that stuff. And I put a mini account up there, a couple of $1,000, gone, and very quickly. Well, maybe I need to change and study a little bit more. And, well, okay, let's go back in and we'll put another couple of $1,000 up and see what happens. Like that. Oh, okay, I don't know enough. I'll do a little bit more study. I studied from 2013 to 2000 I think it was 18, and figured I knew everything I needed to know. I went in with a $45,000 account, and within 3 months, I'd lost $40,000. Now, I'm not stupid. I stepped back from it, and I looked at things, and one of the things that I saw that I was doing wrong was listening to this information that's out there is, oh, you want to get as many pips as you can, so set your profit targets here and do this, and the price will... I step back from everything and I go, wait a minute, let's look at this as a software engineering problem. How do you solve a software engineering problem? Oh, you do this. Okay, let's apply those rules to the currency market, to the trading market. There's a thing in software engineering called the life cycle. The software, it's called software development life cycle, and it shows you how you break a complex problem up into individual pieces that are simpler to deal with. You write some rules, you do the programming for that, put that down, test it, go to the next piece, solve that problem, figure out how to hook those two pieces together, then go on to the third one. That's what the software development life cycle shows you how to step through. And so I translated that into trading, and the term that I apply to that, if you've watched other of my videos, is the life cycle of a currency position, which is entry analysis, position management, and exit methodology. There's rule for each one of those. I have 3 rules. That's all I have in my trading. I don't use any indicators. I look at price action. I want to get down and look at that chart and determine within 15 seconds to a minute, is there going to be something going on here that I should look at as a trade? And there's 3 things that I check to see if there will be a trade at some point, and then I can sit there and I can wait for that event to occur, and then wait until the event is done with and close the trade and I'm done for the day. I did that yesterday. I went in, I was brushing my teeth, and finally the computer booted up, got the trading platform open, and I was sitting there going, holy crap, I got an opportunity here. I'll put a limit order in and then go finish brushing my teeth, and then I came back in, the order had kicked off, it was moving in my direction. I added another block of lots to that order, and it went psh, boom, and in I think it was 20 minutes or so I was done and closed. I'd made, I don't know, $700 or $800. So and that was going to the profit target that I had set, because one time as that price was moving on, it got to a point that was I think it was 8 pips. My profit target was like 20 pips up. In other words, I had breathing room to 20 pips, and I had my stop set at 20 pips, so that if I went away and I had a pin bar up there, I could catch that and then retrain back. But it got up about 8 pips, and it started to chatter a little bit. Yeah, I'm out of here. Boom. So I closed that trade. So I got, I don't know, $150 or something like that. The price actually didn't go down too far. It went down from there 3 or 4 pips. Well, you know, that's 30% of the 10 that it had gone. Turned around and continued back up. I reevaluated the situation, got back in with 50% more of the lots that I had in my original position. As that went up, then I added a few more lots, It went to the point where it started to chatter a little bit again. Boom, and I'm out. And so I made, I forget what I said I made. I don't know, $700, $800, $900. That's pretty good for the bank that I had. I was trading 6 full lots. So I got about 1.7% against that bank risk, right? If I'm trading 6 full lots, I got $60,000 behind it. That's just my risk management. You do whatever you want to do, because you can trade 6 full lots in the United States right now based on some of the currency pairs for $6,500 instead of $10,000. That's up to you. Do whatever you want to do. But the key to the thing is, how many pips are you trying to get? What's reasonable? And you can't just set your thing and let it go and then come back after lunch. You have to sit there and manage the trade, because that's part of the life cycle of a currency pair. Entry analysis, right? Entry analysis, position management, and exit methodology. Well, guess where you're at after you get that entry in? You're in position management. How are you going to manage that position with a trailing stop, or waiting for it to hit a profit target, or not having the rules in place where you can add more lots as it goes forward, or get out early when it starts to chatter? You can't program anything to do that. That's why robots fail. And these robotic systems, they eventually fail because the market changes and it's not programmed to pick that up fast enough. It can't pick it up fast enough because all this stuff takes time. In any event, all of that stuff is based on you determining how many pips is reasonable for that price to move, that you can set that as, when it gets there, there's something else that I want to do. I'm either going to let it run, or beyond that, or I'm just going to close it out because of the uncertainty, and I'm glad to have that amount of money. Glad to have that amount of money is something that I teach the students that talk with me, is how do you determine when that amount of money is enough? And if you don't know that, what are you trading for? You're trading for more pips, and that's the mistake that you're going to make. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.